Hi, I'm Sophia Reyes, Equity Strategy Analyst at Alphatica. Today we're previewing Q2 earnings for the Big Four U.S. banks. JPMorgan, Goldman Sachs, and Citigroup report tomorrow before the open. Bank of America reports Wednesday. Let's start with what the street expects. JPMorgan leads on revenue at $51 billion with EPS of $5.59. Goldman Sachs has the highest EPS at $14.51 on $16 billion in revenue. Bank of America at $113 on $31 billion. And Citi at $274 on $24 billion. Now here is where the data separates them. Bank of America and Citigroup are the street's favorites with ratings of 1.24 and 1.26 from 25 analysts each. On a 1 to 5 scale where 1 is strong buy, that is near unanimous. Citigroup's rating has improved from 1.34 to 1.26 over 12 months. That is the most bullish migration in the group. JPMorgan has also improved from 1.61 to 1.52. Goldman is the outlier. The rating has weakened from 1.62 to 1.8, the only bank where the street has become less bullish. Now the price targets. Citigroup's target has increased 79% in 12 months. Goldman is up 72%. Bank of America up 29%. JPMorgan up 28%. But here's the catch. Goldman at 1041 against a target of 1045 has less than 1% of upside. JPMorgan at 335 against 357 has about 7%. Citigroup at 139 versus 157 has 13%. Goldman needs the guide to justify staying here. Citi still has room even on a clean beat. We ran event studies on all 4 banks using every earnings release since 1996. 3 patterns. First, Q2 is historically positive. JPMorgan averages 1.55%. Bank of America 2.32, Goldman 2.8. Second, banks beat almost every quarter. JPMorgan 19 of the last 20, Goldman 16 of 20, Bank of America 18 of 20, Citi 17 of 20, misses cluster in Q4. Third, the bigger moves come in the 10-day window, not the initial reaction. 3 themes to watch. First, net interest income. The NII outlook for the second half is the most important line item. If banks guide higher, rate hikes become a tailwind. Second, trading revenue. The Iran conflict and rate uncertainty created an exceptional environment for Goldman and JPMorgan's trading desks. Third, credit quality. Our H8 data shows commercial loans contracted $14.5 billion last week. If that shows up in rising loan loss provisions, the sell-off will be immediate regardless of the beat. The actionable setups. Highest conviction is Citigroup. Rating improving, target up 79%, 13% upside to target. Q2 is historically Citi's best quarter over 30 years of data. The contrarian play is Goldman. Weakening rating but target up 72%. That divergence resolves on earnings. A trading revenue beat reverses the rating. A miss confirms it. The safe play is JPMorgan. 19 of 20 beats. But at 335 with a target of 357, the upside is in the guide, not the beat. Bank earnings start tomorrow. The beats are consistent. The debate is about the forward guide, NII trajectory, trading revenue, and whether the credit contraction we've been tracking shows up in the provisions. This is Alphatica. We track the data.